Hello and welcome. My name is Erik Schatzker. I am an editor-at-large here at Bloomberg in New York City, and this is the Global Outlook, our next panel at the Qatar Economic Forum. First, I'd like to introduce my distinguished panelists. Jenny Johnson is the CEO of Franklin Templeton. Manny Roman is the CEO of PIMCO. David Rubenstein is the co-founder and co-chairman of the Carlyle Group. Together, they oversee approximately $4 trillion in assets. Folks, I'm going to be asking at least one polling question over the course of the next half hour, so please pay attention and do, if you would, respond when you hear me introduce a poll. I don't see any reason we shouldn't begin with our questioning right now. Panelists, the COVID-19 recovery trade has been nothing short of breathtaking. And if you were bullish on reopening and positioned for reflation, it has been extremely profitable. Manny, you speak for $2.2 trillion at PIMCO. Are you bullish? Does the recovery trade have room to run, or has it played out, and why?
Well, thank you for the question. I think that you have some sectors which have been incredibly good to invest. I think in March 2020, you had real opportunity in high yield and in private credit. And for all of us, I think it's been very good. There were special situations to invest in. And I think people who put capital to work have been very happy. Now, if you look at the high yield index, a lot of it has played out. You may have another bite at the apple if there is some tapered tantrum down the road. And then there are sectors which I think will be incredibly exciting to keep on investing. Real estate being one of them. I think that real estate is one of the sectors which hasn't fully recovered. There's a lot of question mark and uncertainty about the role of officers, who's going to come back to work, how is it going to work, and I think the whole sector should provide for astute investors to be a real opportunity.
Manny, just a quick follow-up there. Given what you've just told me and told the audience, what's PIMCO doing? How do you position to take advantage of the opportunities, even if there aren't so many any longer, that still remain?
Well, in a mutual fund, and I think I have to be a little bit careful and distinguish a mutual fund from the private side of a business, which has long lockup structure. But on the mutual fund side, we've taken some profit. And I think we want to be flexible enough cash to capture opportunity. And so there were time to buy incredible assets in March and April 2020. They have rallied quite a bit. I think you have to be disciplined and make sure you have dry powder to be able to deploy it. And I don't need to tell you, as the last panel pointed out, that there's a lot of uncertainty about what's going to happen with inflation. We have a view. We may or may not be right, but I think we'd also try to invest around this. There's plenty of opportunity in emerging market. All of those questions, I think, leads you to take profit on some of the position that you took in March 2020 and make sure that you can redeploy your portfolio.
Jenny, you oversee an extraordinary range of strategies at Franklin Templeton. Are your strategists and portfolio managers telling you what we just heard from Manny? It's time to raise your cash allocation. It's time to take profit. It's time to wait for the next taper tantrum, perhaps before deciding to invest more aggressively?
Well, let me first say that unlike Manny, with the $1.5 trillion that I oversee at Franklin Templeton, we have 14 different independent investment teams that have very different views. We have great debates internally about inflation, and we span the entire spectrum. And so I do not speak for them. They are completely independent. And I would say that, I think the reopening trade, what we do agree on is that you're going to see this in waves as the vaccines roll out. Obviously, developed markets like the US and Europe are further ahead, probably hit 75%. And I think the US is projected in 5 months and EU even sooner. But then there's other markets that are much longer. Russia 12 months, India 19 months, Indonesia 23 months. And so I think we're going to see this stimulus, this reopening stimulus kind of in waves and carry through. I think that, we're bullish on things like, commodity currencies in areas where you're protected if there is more inflation. I think cyclicals, we still think that there's still run. Again, 14 different independent teams who have their own view. So, each one independently comes up with their conclusion there.
David, Carlyle invests with a much longer horizon. And so I wonder, from your point of view, have the best opportunities in the recovery trade already played out, or do you see them still ahead?
Well, it's too early to know for certain, but I don't think we feel, and I don't think people in the private equity industry feel that it's too late to pursue good transactions. It's been clear to us that the Federal Reserve is not going to increase interest rates this year, and almost certainly not for a number of months into next year. We'll have to wait and see exactly how long they wait before they actually increase interest rates. But as long as interest rates are reasonably attractive, as they certainly are now, and as long as the Congress of the United States doesn't do anything that's deleterious to the economy, and I don't see anything like that happening now, I think the private equity world is generally doing pretty well. Profits are being taken off the table when that's appropriate, but many good deals are still out there. Prices are not cheap, for sure, but people have gotten comfortable with somewhat lower rates of return than maybe 10 years ago because the alternatives are just a lot less attractive than anything else. So private equity continues to do well, and many investors are putting a lot of money in the private equity because they like the longer-term nature of the business, but they also think that the returns are likely to be better than anything else they can legally do with their money.
There are multiple forces reshaping the global investment landscape, from monetary policy, of course, to shifting geopolitics, to technological disruption. Jenny, I'd like to begin with you here. What do you consider the most important or dominant of these forces, and how are you responding to them?
I actually think that the underappreciated disruption force is really blockchain. And I think what's happened with things like cryptocurrencies like Bitcoin have been the greatest distraction to understanding really true disruption that I think is coming. And I think we're at the tip of the iceberg. So within finance, you hear, decentralized finance. I think that's going to be significant. And when I say, the distraction, I think that's non-sovereign backed. I think you're going to see sovereigns who express their currency in digital, and the reason is it's better from a cybersecurity standpoint, so counterfeiting, and I think it's better from a being able to track payments and therefore being able to tax on things. But with the technology, and when I talk about the business model, the ability to kind of pay your client for the value they bring, I think is a whole new model. So let me give you a couple examples. There's something called Tether TV. Tether TV is a streaming service that tries to be the fastest streaming service. When you're watching content, they're paying you T-Fuel coins and leveraging your device to cash it to others. So you suddenly become a client who has become also part of your infrastructure. Imagine in the case of a search engine like a Google, where today when you're searching, your profile is completely the asset and advantage to Google. Well, what if, would you change to a new search engine if you were actually paid tokens for some percentage of the value of your profile? And I think that these business models are really early stage in understanding them. I think it's going to be very disruptive. And then I think for asset management, the ability to tokenize ownership is going to unlock illiquid assets, because the frictional cost of transacting, selling my ownership to somebody else is going to be dramatically reduced, which is going to democratize a lot of historically illiquid assets.
Jenny, at a corporate level, are you making a bet? Is Franklin Templeton making a bet on blockchain or tokenization?
So first of all, we announced that we are working on a tokenized money market fund. So right now it's in pilot. We're working with the SEC. We've built the what's called the kind of the books and records, the transfer agency on the Stellar network. We're right now piloting to ensure that is consistent with our traditional transfer agency system before we want to retire it. We make investments in blockchain companies, and we continue to look at the space, we have an incubator. So we had a company like Curve. You may have heard they were a crypto wallet. They were one of our first companies in our incubator. So we're focused on this space.
You've given me a perfect entree to our first polling question. This is an alert for the audience. Here comes the question. Do you desire some form of crypto exposure in your investment portfolio today? It's a simple yes or no question. Do you desire some form of crypto exposure in your portfolio? And as we wait for those answers to come in, I'll move on and ask this question. It's not just crypto. The newest generation of investors, young adults in their 20s and even kids in their teens, have rallied around three powerful trends in the markets. Crypto, as I say, is one. Meme stocks is another. And SPACs are a third. And I'm very eager to have your perspective on this, David. Crypto, meme stocks, and SPACs, are they for real?
I think they are. Crypto's case, I would remind people, it's not in the 10 Commandments that you have to have governments issue currency, and that can be the only currency that people use. So other currencies can be used. And remember, before governments actually issue currencies, they were issued by various banks or other kinds of institutions in a society. So I think crypto is here to stay. It's too late to change it. It can be better regulated, perhaps, than it is. Maybe there should be more disclosure. But I think people are looking for a different way to put some assets to work where they don't really feel that there's inflation that's going to be a big problem for them. So it will have its ups and downs for sure. And I think the greatest opportunities there may be in things that help transfer assets from one type of digital currency to another, or help trading, or other things relating to blockchain, not necessarily investing in a particular currency. I think what we're seeing is that before COVID, we had a digitization of the society, and it was moving forward. People were used to their smartphones and so forth. But during COVID, we got used to even more digitization, and I think it's too late to put that genie back in the bottle. So for the next 5 years, 10 years or so, you're going to see a massive change in the digitization of our society. And the things you just mentioned just reflect that, are the tip of the iceberg. I think we're going to be here for quite a while in terms of watching the society move towards more digitization. And gradually, the people who are the younger people who are making these changes and also forcing us who are older to look at them are the ones who often move economies. Economies are generally moved by younger people making purchases or coming up with new trends. That's true for a long period of time, but it's become even more true now as we see these kind of stocks, these kind of currencies, and these kind of assets being pushed in large extent by younger people.
Manny, I know that PIMCO has and here we are with the results for the moment of our polling question on crypto. And as many of you can see, it's a dead heat. 50% of the audience wants some form of crypto exposure in the portfolio today. 50% doesn't. But can you imagine what these numbers might have looked like a year ago, 2 years ago, 3 years ago? I should just ask you, Manny, would you have anticipated a dead heat like that, 50% for crypto, even a year ago, 2 years ago?
No, certainly not. And I think one of the factors, to come back to the question you asked before, and to answer the same question than David, is that we had a recession with COVID like nothing we've seen before. And the instrument in terms of sending checks to the American people were blunt, but it also gave purchasing power to a lot of people who also stay at home. And I think you saw a flurry of trading activity in both meme stocks and in crypto that you can look at as a way to invest, or you can look at legalized gambling. And I think both views can be justified. But what is very clear is that a lot of these companies don't deserve the valuation that they get. Last time I checked, markets are more or less efficient. And the only way to explain the valuation of a stock is price earning. And you can discount future growth, and you can discount future market share and future profitability. And you can make a convincing argument why so many tech stocks trade at such high valuation. But at some point in time, you do need to make money one way or the other. You do need to have a business model which wins. And I think that some of valuation and some of the volatility in all of these assets make absolutely no sense.
So you believe in the fundamentals still, and as a result, I don't want to put words in your mouth, but it sounds to me as though those meme stocks are a short.
Well, it takes a very brave person to short, because unlike long, if you short and you're wrong, your exposure goes up. I think you stay away. Stay away is the best thing.
And I know that PIMCO has a considerable SPAC business as part of your special situations unit. But tell me, how do you harness the enthusiasm and interest in the meme stocks, in platforms like Robinhood, in crypto? They aren't elemental to what PIMCO does, but perhaps there's a way that you can take advantage of them.
I think we try to stay focused. I think we run a very tight fixed income shop, and Dan Iverson and I think, have the view that we as good as our returns. And we focus on investing in fixed income and in real estate and do the best possible job. And there's a lot of things we don't do. And there are other people, some of them on this panel, who do a really, really good job at other things. And we try to focus on what we know how to do. And you know, if you come back to the same thing again and again, our clients come to us for performance. And they come from us to be focused. And if Robinhood is a great, successful business, so be it. And it's wonderful for them, and we can both coexist very happily in the world.
Jenny and David, do you share Manny's view on meme stocks, that they're overvalued and perhaps, if not a reason to short, a reason to stay away?
Absolutely. I mean, I think that, you know, professional investors like predictability. They like to know that there's value in the company and that you're measuring that value. And the meme stocks are more of a social phenomenon that doesn't have, you know, specific value tied to it. Therefore, it's just, you know, it's unpredictable. And sadly, I think that, you know, you can end up with a lot of folks getting burned that don't really understand how much they're risking and how burned they can get.
And what about you, David? Are you buying into the secondary offerings by GameStop and AMC?
Well, let me just say that I don't think people should put all of their net worth into these kind of stocks because they are risky for sure. But remember, the art of investing is the art of predicting the future. And to some extent, nobody can really predict the future, but for some part of one's assets, you might take some speculative risk with the idea that if you lost that money, it's not the end of your existence. So some small amount can go in there. Remember, investing for some people is pleasure. It's fun. And it's not only to make money. They'd like to make money, but some people get a great deal of enjoyment out of playing the market, doing these kind of things. And if it's a small amount of their net worth, I don't see any great harm in it, assuming it doesn't overall affect the overall system of our economy. But generally, I'm not as worried about it. I am more worried about gravity. Eventually, the great economy we have is going to come down. Gravity always takes force and takes over. And so at some point, we have to recognize that not just for these kind of stocks and these kind of assets, but for all the economy, gravity will take hold. And I suspect it will be at some point when the Fed is clear it's going to increase interest rates, and everybody knows that's going to happen in the not too distant future. And if Congress ultimately decides they're going to have tax increases, that'll have a effect on the economy and produce some gravity effects as well. But remember, things can't go on forever going up and up and up. At some point, they'll go down. So I think people should be cautious. But my point here is, if you had take 5% of your net worth or some small percentage, and you go into these kinds of assets with the understanding you could lose it all, and you enjoy doing it, and just the thrill of investing in these kind of things gives you some excitement, I don't think it's the end of the earth. I just wouldn't put too much of one's assets in that.
Speaking of the immutable laws of the universe, panelists, a question for you on climate change. Climate change is the existential challenge of our time, we might say, and some of your peers are taking an activist position in the climate change debate. I want to know what you think. Where, Jenny, do investors, asset managers belong in the fight against climate change?
Well, I think, look, as you said, I mean, it is the big question, and we're managing money for clients, and so if your clients want their money where it's invested in such a way that it's having an impact, lower carbon emitting companies and companies that are progressing towards this. I mean, the spectrum goes, let me consider these factors all the way to, I want a, specific green bond fund, say. I think it's here to stay. I think that the data is not great as far as companies reporting on these things. It's getting better. As asset owners and managers on behalf of clients, we have to respond to that. So I think it's a part of our investment process, and I think it's a part of every asset manager's investment process, because I don't think this issue goes away. I think it just continues to grow, and the awareness continues to grow.
David, what do you think? Should asset managers take a stand on climate change?
I think they should do the best thing they can for their investors, and to do something good for your investors means taking this into account. Clearly, climate change is recognized around the world as a global force that's going to change the way we live and conduct our lives for forever. And if we don't do something about it, we're going to be harmed. Therefore, if you're going to be an investor, you have to take this into account. So good companies are going to be ones that take into account climate change. Bad companies are the ones that ignore it. So if you're investing in these so-called bad companies, you're not likely to do as well. So as the zeitgeist of the era is moving towards a recognition that climate change is here to stay, if you invest in companies that don't take it into account or are not sensitive to it, you're not likely to do that well. So I think not just because it's a socially responsible thing to do, but because you're likely to get better returns if you are sensitive to these issues. I think all kinds of investors should take these into account. We do in private equity, and I know in other areas people do as well. Private equity firms are now very sensitive to climate change and ESG-related concerns, because they think it's not only good for society, but it's going to actually lead to better rates of return.
Manny, do you share that point of view? Do investments with sort of a climate change tilt offer or promise better returns?
Well, we don't promise anything, and I think we're incredibly careful about what the future looks like, because the reality is we don't know, especially in the fixed income world. So we are very, very careful about making any promises. That being said, every single bond we own has an ESG rating. We have a whole team dedicated to the effort. We're incredibly active in terms of making sure we understand the climate risk in our portfolio and in our various clients' portfolio. And then clients have very different utility function and very different constraints. And we try to manage money in the best possible way we can for different clients. I'll give you an example. Our parent company, Allianz, for whom we manage a lot of money, has made a commitment to be at net zero in 2040. And so obviously the portfolio will look quite differently than some other investors who made no commitment. And so you have different glide path and different asset constitution depending on your view in terms of where you want to be in 2030, in 2040, in 2050. But I think one needs to be flexible. I think one needs to be realistic about what the returns will look like, knowing that some assets, as David pointed out, may become stranded. There are sectors of the economy where a lot of investors will decide that this is not for them. You can think of coal, for example, where a lot of investors will say, you know what, we don't like the coal industry. We don't want to invest into coal. And those assets may become very cheap. And they may become cheap enough that they provide great investment opportunity. And, all of us will be confronted to these issues down the road.
Manny, I'm going to stay with you because you raised this point earlier in the conversation. Just 3 months ago, inflation seemed like the most pernicious threat to the global recovery. Today, however, the market seems to be accepting Fed Chairman Jay Powell's assurances that inflation is transitory and under control. What do you think?
Well, we coined the term head fake and said that inflation was a head fake. Now, what does it mean? It means that you're going to see a number of prints where you'll see inflation going up over the next few months. Why is that? Because the economy is coming back to work. We never gone through this before. It's going to be uncoordinated by nature. You see supply issue in both the labor market, where people are slowly going back to work, but when when they stay at home for a long time, you may have some inflation in wages for the time being. And then you will also see global trade being impacted and some inflation pressure, chips being one of them, being the obvious consequences. Now, this is, in our view, a transitory phenomenon, and that the deflationary forces which are at work in the economy long term will take over, and you'll see inflation gradually coming down. I think that the message from the Fed, which in our view was hardly surprising, is yes, we are a little surprised by how inflation has gone up, but we're here to act, and we're here to raise rates in case we need to. And the market has reacted in an extremely rational way. The curve has flattened, and the 10-year has gone from 162 to 148, and pricing inflation expectation the best the market can.
David, everyone I talk to in your industry, private equity, says that he or she sees inflation at every stage of the supply chain. Carlyle owns hundreds of companies, indirectly employs hundreds of thousands of people. What do you see?
Well, I work in the White House when we had 15% inflation in the Carter years, so I know what real inflation is, and this is not that type of inflation. We've had for the last 25 years, we've had 2% or so inflation. So when we go to 3% or maybe 4% for a brief period of time, it does seem a high compared to the 2% we've averaged. But the truth is, 3 or 4% inflation historically over, let's say, 50 years or so is not a terrible rate of inflation. So people, I think, have to get used to the fact that we're coming out of the COVID period of time, and people are spending more. People are anxious to do things they couldn't do for a while. So it's not unlikely that we'll have 3 or 4% inflation for a brief period of time. But I don't see anything going above 4% any sustained period of time. I think it's likely to settle back, as the Fed thinks, to probably a more normalized 2.5%. So I do think that prices are going up, and we do see it in our companies, but I don't think it's anything to be alarmed about at this point. And in fact, we see in some areas inflation is going down. Lumber, for example, was thought to be very high for a while now. Prices are coming down. I suspect you'll see that in other parts of the economy as well as people adjust. So I'm not that worried about that. There are bigger things to worry about in the economy, in my view, than inflation going into a much higher rate than we can really tolerate.
While we still have an opportunity, I'd like to ask my second polling question of the audience, and here it is. Which region represents the best future investment returns? There are 5 options: Europe, North America, Latin America, Africa, or Asia. Again, which of the following represents the best future investment returns? Europe, North America, Latin America, Africa, or Asia? I'll give the audience an opportunity to answer and put this first question here to you, Jenny. Where by asset class, strategy, or geography do you see the most attractive returns right now?
I think, again, this depends on kind of the reopening rollout and how quickly, folks can respond, or different countries are responding. And you're definitely seeing places like Latin America, in parts of emerging markets that are much slower and haven't gotten COVID really under control and haven't gotten the vaccine rollouts. And so they'll be more delayed. Again, I kind of mentioned, I think that the U.S., we're seeing, you try to book a flight, they are booked. You try to get a reservation in restaurants. People are getting out, and I think that in the short run plays better for the developed markets. And that's where I said, I think there's still room in the cyclicals, real estate. And then I think that, again, against a little bit of a hedge on inflation, commodities and some of these commodity currencies, I think are good place to position yourself.
David and Manny, I have to come to you very quickly on this one. Where do you see the best returns by asset class, geography, or strategy at the moment? Manny.
I like the U.S. I would go long the U.S. I think there's going to be plenty to do. I think the U.S. is an incredibly deep pool of alpha being stored. And then I like Asia, and I think that people are going to make money in Asia for the next 10 years.
David,
Now,
quickly, last word to you.
On a risk-reward basis, nothing is comparable in the world to the United States on a risk-reward basis. If you're looking for just high rates of return, probably China and other parts of Asia are probably going to have somewhat higher rates of return over some period of time. But on a risk-reward basis, taking into account rule of law and other kinds of things, nothing is comparable to the United States, not even close.